In our next presentation, we'll hear about research from the International Monetary Fund on how the public sector, meaning central banks, can work with the private sector to harness innovation and issue central bank digital currency-like assets. It is my absolute pleasure to introduce someone who is leading this research. Tommaso Mancini-Grifoli is the Division Chief of Payments, Currencies, and Infrastructure in the Division of the International Monetary Fund. His work centers around digital currencies, payments infrastructure, monetary policy, and foreign exchange. And he's also no stranger to the private sector, having worked at both Goldman Sachs and the Boston Consulting Group, as well as several tech startups right here in Silicon Valley. Please join me in welcoming Tommaso to Meridian.
Thank you very much for that very nice introduction. I wish I were with you there in the Silicon Valley, a place very dear to my heart, and where I've had some wonderful experiences. And thank you for the invitation to speak to you about public-private partnerships and the coexistence of public and private forms of money in the digital age. So I think I have about 20 minutes to speak, and then I'll take questions for the remainder of the time, which is about 10 minutes, I believe. And thank you very much for putting the slides up. So on the next slide, we'll jump right in. And when we look around, we see a multitude of private forms of money. We clearly know about bank deposits that we use for retail purposes. There are bank deposits that are designed for institutional investors as well. There are now e-money schemes such as M-Pesa in Kenya, or Alipay or WeChat Pay in China. Those are the most popular ones, but there are a lot of others. And stablecoin schemes, et cetera, et cetera. We have this plethora of private forms of money that exist. We also have public forms of money, the notes and coins issued by the central bank that we carry in our wallets, and importantly, central bank reserves that are issued to a subset of the banks in the financial sector. Now, next, the question is why? Why is it that we have this multitude of different forms of private monies? Why is it that we have the coexistence of private and public forms of money? We know it's there, but when we scratch our heads, why is it? And I think what I'd like to do is just go through a little historical example to discuss that. And public forms of money in history have been quickly surpassed. So I start here with the gold coin issued by the city of Florence, where I'm from. This is a very patriotic slide. So the gold coin is issued. This is a symbol for a public form of money. And then things happen. On the technology front, we see a large range of innovations. Double entry bookkeeping, that's an innovation. We see letters of credit emerging and all sorts of other innovations. On the supply side, we have new issuers, new banking families, new merchant classes that are interested in participating in the financial sector. On the demand side, we have new evolving needs of merchants as they start to travel during the Renaissance. They need money that they can bring with them without stuffing their pockets, without risking encountering a bandit and losing all the money that they have. We start to see the need for credit to expand businesses. And on the policy front, we obviously see new frameworks being created, both legal and regulatory, around all of this innovation. And so if you click next, this is what we see. We see account-based forms of money. And here the account-based forms of money are symbolized by the book, the double entry bookkeeping, that are starting to emerge. We see experimentation, demand deposits, time deposits, equity claims, all sorts of different types of account-based money that start with oral settlement, and then this introduction of a new technology, lettere di cambio, that start in the early 1300s. that start to enable merchants to travel with a piece of paper that says, I owe you this much money. And they can actually, upon arrival, pay with that. We start to see the invention of limited liability companies in Florence, 1408. We start to see clearinghouses being formed, some quasi-public. Banco del Rialto, 1587. Bank of Amsterdam, 1609. And then we start to see, of course, the rules and regulations being put into place around all of this innovation. And the Riksbank is, of course, the first central bank established in 1657. So this is a brief review of history that suggests that the public form of money, that gold sovereign, just was no longer able to meet the needs of these new classes of merchants, was no longer really compatible with the interest of the new classes of merchants and banking families, was surpassed by technology. And all of this led to innovation, competition, which was more or less contained with new frameworks. Next. So public forms of money are surpassed, and nevertheless, they remain. And they play a key role. And the question is, what role and why do they remain? So again, let's go back to our stylized example. In purple here, we have the private forms of money, whatever they are, deposit, bank deposits, e-money, whatever, or different types of bank deposits. A, B, and C just stand for different forms of money. And we have central bank money, notes and coins, and the reserves that some banks are able to hold. And there is something magical that happens in between. Next. And that is this notion of redemption. This notion that private forms of money can be redeemed into public forms of money. Specifically, redemption takes on 4 forms. The first is redemption stability. The fact that you can exchange $10 in your bank account into a $10 note, the fact that you can redeem at a fixed face value is very important. That is what we call redemption stability. Redemption commonality means that all the different banks issuing their own forms of money, after all, the deposits that we hold, so this is Citi, Bank of America, Wells Fargo, all the banks that you can think of, are all able to redeem into the same asset at the central bank. That's very important as well, and I'll explain why. The third element of redemption is that it's feasible. There's actually an infrastructure that's been put into place for for Citi, for instance, which gets paid in the liability of JP Morgan. And that liability can then be transferred into central bank reserves. So there's an infrastructure, redemption feasibility. And finally, redemption clarity, which means that there are laws and regulations that encapsulate all of this. There are rules of the game so that this redemption can be done. So why is this important? Next. Because these 4 different aspects or dimensions of redemption allow for 2 important things. They allow for private forms of money to be a safe store of value. There's a 1-to-1 exchange rate between those $10 you hold in the Citi account and the $10 bill that you can get out of it, so that private forms of money are a stable store of value. And private forms of money become an efficient and enticing means of payment because there is interoperability. If you hold $10 in a Citi deposit and I own a JP Morgan deposit, you can pay me. And that's very, very important because money is, after all, the means with which we transact between different individuals. So interoperability is essential. Homogeneity of value. Those $10 you have in the Citi account are worth $10 in the JP Morgan account, and you can pay for $10 worth of goods. So there's a homogeneity of value that is created. There's also multiplicity. There is a diversity of different forms of money because they're dissociated from whatever gives them stability, the central bank money. So there's one central bank money, but 1,000, 2,000 different types of private forms of money, and each caters to the different needs that we as end users have. So there's a multiplicity that can exist thanks to this redemption. And finally, there's of course innovation that can take place. There's a new entrant that can come in and offer a new type of money, maybe catered towards my particular needs, and that form of money will be interoperable with all the others, etc., and will be stable as long as you have these 4 different dimensions of redemption. So redemption from private forms of money to public forms of money ensures a safe store of value and an efficient means of payment for these private forms of money. That's the world that we know of today. Next, so let's talk about CBDC, which our host so kindly defined at the beginning of the program. CBDC, will it supplant private forms of money? When central banks introduce their own digital liabilities, their own digital forms of cash, will we no longer use all these different forms of private monies that we have today? And this comes down to whether we design CBDC more like a coin, more like cash, or more like a deposit in a commercial bank. So there's a big debate now. It's either CBDC as a coin or either CBDC as a deposit. We don't think that that is the right debate. So let me illustrate the debate for you. So on the left-hand side of your screen, you'll see CBDC designed more like a coin. So this is the idea of in the parlance, on the websites that you read, in the speeches of central bankers, you might see this referred to as two-tiered CBDC. The idea is that the central bank defines this new token. It defines and issues this CBDC. And the private sector distributes it. So you go to your bank and get cash today, much in the same way you would go to perhaps also your bank and say, can you load my wallet with this central bank coin that the central bank has invented and that the central bank maintains and the central bank settles as I trade it. So that's a central bank coin, a central bank technology distributed by the private sector, much as cash is today. The alternative on the right-hand side of your screen is what we call synthetic CBDC. This is a term that we introduced, that Tobias Adrian and I introduced in a paper last summer. And the idea here is that the private sector issues its own coin. The private sector issues its own coin, but that can be risky. So the coin is fully backed with central bank reserves. Suppose there's an issuer that gives you $10 worth of coins and the issuer holds $10 worth of central bank reserves, or suppose that that's cash in a vault. And this is done under the supervision of the central bank. So the private sector here is innovating, is creating this form of money, but it's fully backed, so it's safe. And I think until now we've been seeing these two approaches to CBDC as two very different approaches that need to be contrasted, and central banks need to decide whether they go one way or the other. And we don't think that is the right way to think about it. Next. So what happens? Suppose the central bank introduces a two-tiered CBDC. So it introduces its own coin. It's come up with a new technology. It says, okay, this is what the technology is going to look like. This is what the coin is going to look like. And you can get it by downloading our wallet and filling it up by going to your bank. Next. Well, I think that what we'll see is that the same forces at play that we saw earlier in the historical example will continue to be relevant. There will be new technologies. There will be our needs as users will evolve, and perhaps very quickly. And there will the interests of other issuers of money will evolve as well. Let me be specific about each one of these. And what I'm going to suggest is that because of this, a CBDC introduced tomorrow introduced today, is likely going to become slightly out of date tomorrow. Tomorrow meaning in a year and 5 years or whatever. So next. What happens when new technologies evolve? So the idea is that technology, whatever technology the central bank picks today, is likely to become outdated relatively quickly. Because we know that technology evolves according to this S-curve that I've illustrated here. And here are two simple examples, a microchip and an image processor. So suppose that the government had been in charge of picking the best technology for a microchip at the beginning of the computer revolution. Suppose the government had been in charge of picking the right technology for an image processor at the beginning of the digital photography revolution. Would we have had the same level of innovation? Would we have the same breadth of products that we see today? And the answer is likely not. What about evolving needs? So suppose the central bank introduces the CBDC next, and we are likely to see our needs evolving very rapidly. New and unpredictable use cases are likely to emerge. Information may be and assets may be put on the ledger in ways in which we can't completely imagine today. New applications may be developed that need new APIs. All of these evolving needs might make the CBDC introduced today outdated tomorrow. What about evolving interests next? And here, the interest of, perhaps, let's focus on the interest of e-money issuers. So e-money issuers might be seen as risky, and we might need to find ways to make them safer. Or they themselves might be looking for greater safety in order to make their products more enticing. They may be looking for ways to make their products interoperable so as to make their products more enticing. They may be knocking at the central bank's door saying, can we please back our coin issuance with your reserves? And that might push the market away from the CBDC of the central bank towards something that starts to look more like synthetic CBDC. So next, I'll conclude with the next slide. And I'd like to illustrate with this slide the fact that CBDC introduced by the central bank may well have a purpose and is likely going to exist, but to coexist with a synthetic version of CBDC. So we're likely to go back to this dualistic system where we have central bank money that serves a certain purpose and a private form of money that serves another purpose built on top of it. And we're likely to see the two interact through redemption. So let me just illustrate very briefly. Suppose the central bank puts out this two-tiered CBDC, all right? So it sent out this two-tiered CBDC to a couple of users. Users start to see this as outdated. So next, what happens is that issuers come in and they buy up these central bank digital currencies that we use and don't no longer like so much, and issue their own liability in exchange. So they're holding a central bank asset and they're issuing their own liability, their own coin to us, the end users, drawn up in little circles at the top. Next. So what happens here is that we have two layers. We have the CBDC layer the central bank has issued, and the synthetic layer that private issuers have issued. Next. So, of course, the CBDC layer serves the purpose of redemption commonality, feasibility, and clarity. Because now the coins issued by these private sector players can be interchangeable. Next. And that, of course, means that these coins, these privately issued coins, become an efficient means of payment because they allow for interoperability, multiplicity of solutions, innovation, etc., as we said earlier. Next. And the CBDC layer here has to offer redemption stability in terms of you can get a central bank liability back. You can get $10 worth of CBDC issued by the central bank in exchange for that coin that you're holding. Next. But for that to happen, we need a new regulation and new legal basis. So this is where we need to make progress. We need to create licensing agreements and regulation in order to allow the private sector to innovate on top of CBDC. Next. Nevertheless, we realize that CBDC may well have a purpose. So the first question, of course, that this raises is that, well, if the purpose is only to make coins of different issuers interoperable, then maybe just a fast payment system that is available to a larger number of players is sufficient. But not if the central bank has other objectives. Suppose the central bank wants to foster financial inclusion by making its CBDC available to people who might not be able to use to hold the privately issued coins, who might not be deemed economically viable. Suppose the central bank wants to have a CBDC for purposes of national cohesion. Suppose that the central bank believes people have a right to hold a state-backed currency. Even if it's clunky after a while, there still is a purpose for CBDC, in addition to serving the purpose of making the privately issued coins interoperable. So let me just conclude and summarize with the next slide. So what I tried to suggest today is first go over the fact that there's a coexistence of privately and publicly issued currencies today, and that's likely to persist tomorrow. That's important because it allows for diversity of forms of money, that allows for innovation and competition. The central bank money, though, remains important. It's not going to go away, and it needs to stay that way in the future as well. It's important for redemption, which underpins the stability of value and the efficiency as a means of payment of these private forms of money. So CBDC and the synthetic version are likely to coexist in the digital world, just like we have coins and bank deposits today that coexist. CBDC offers interoperability to new non-bank providers of money, and at the same time may favor financial inclusion and other policy goals, as we just described. So SCBDC would remain at the forefront in the meantime of technology and user needs. But in order for all of this to fall into place, we need to upgrade our regulatory and legal frameworks to allow for this. So this is just as important as working on technological innovations. So there you go. I tried in the last 20 minutes or so to suggest that today's world of duality, private and public forms of money coexisting, is likely to continue and is desirable to continue in the digital age. Thanks very much.
Well, thank you, Tommaso, for that really insightful presentation. I personally really enjoyed hearing about the evolution and potential around synthetic CBDCs. That's not something I had quite an understanding of. And as well, I thought your points around how government adoption could lead to stagnation and kind of the complexity around that problem to be really interesting. And of course, at Stellar, we tend to be really excited about how technology can facilitate greater financial inclusion. So your comments on that topic were also appreciated. We're going to take some time to get some questions from the audience right now. I've got a couple pulled up here, but I will also invite any viewers out there to submit questions. So I think to kick things off, I found this question interesting. If we look at counterparty risk for a CBDC, it would theoretically be lower than that of a commercial bank. So is it possible that a redemption ratio would be less than 1-to-1, if you're kind of building in some of that reduction in counterparty risk?
Okay, so CBDC is likely to have less counterparty risk than a commercial bank deposit. I agree. The commercial bank can default and you can lose your money. Now, that's a problem. And it's not so much a problem because, so speaking of redeeming CBDC is not quite right, because it's hard to speak of redeeming cash. What do you redeem cash in? You can redeem a $20 bill for 2 tens, but you can't redeem it into anything else than cash. The same property would apply to a central bank digital currency. That's simply a general property that applies to a central bank issued form of money. Mm-hmm. Nevertheless, the question is very important because there is a risk here of disintermediating the banking sector. If you introduce a form of money that has lower credit risk than a commercial bank deposit, people might move out of commercial bank deposits into central bank money. And that would be a problem because banks serve a purpose of distributing credit to the economy. So there are ways to discourage an excessive movement of deposits out of the commercial banks into central bank money. And first of all, you might make commercial bank deposits very safe. So you could offer a deposit insurance, as many countries have. Mm-hmm. The other thing is perhaps introducing an interest rate differential between the two. Suppose that your commercial bank gives you a certain interest rate on deposits, and suppose the CBDC does not. Or suppose that after a certain amount of CBDC that you hold, you might be asked to pay penalty rates. Or suppose there's simply a harsher quantity limit, so that you cannot hold more than a certain amount of CBDC in your wallet, and anything you receive in addition gets swept into a bank account at the end of the day. Those are all possible ways to address this very real risk of banking sector disintermediation coming from exactly what this question identifies, the fact that CBDC has lower credit risk.
Very interesting, and I appreciate you talking us through that. Okay, so another question I have for you is, how realistic or imminent is regulation that could actually support things like synthetic CBDCs? I guess, kind of, what does this path forward look like, and do you have any sense of kind of what the feasibility or time horizon is for that kind of product in particular?
Yeah, that's a great question, because it's such a central aspect of what synthetic CBDC is about. It cannot exist without a very, very clear legal and regulatory framework that touches on a variety of things, such as, for instance, whether a synthetic CBDC token would be bankruptcy remote. Suppose that you own a token from a private issuer A, and well, it's backed with central bank money, and it's backed one for one, and that backing is monitored on a continuous basis. So you're pretty sure that it's safe in normal times. But suppose one day the issuer goes bankrupt. Question is, can you get your money out of the central bank before another creditor does? So these types of arrangements need to be put into place so that synthetic CBDC is very safe. Now, there are countries that have actually that are starting to introduce legislation to offer these types of services. Special payment licenses, banking light licenses. So there is progress being done in this area. And I know that central banks are very interested in these prospects, and to some extent the policy community can move fast on these areas. It's important, though, to move at a pace that ensures stability and does not introduce new risks, obviously, into the system.
Sure, great. Well, appreciate your response to that question as well. I think I have just one or two more. I would be remiss to not mention that there are some privacy implications to a full transition to something like central bank digital currencies as kind of the underlying or predominant fiat currency. How do you think about that? In your research, or do you guys explore privacy and kind of implications for what this type of new technology could mean? Do you have any thoughts about that?
Yeah, I think the first thing to consider that you and the audience may find interesting is the distinction between privacy and anonymity. They're two relatively different concepts. You might not necessarily care about anonymity. You might care more about control over who has access to your data and what is done with your data. So we tend to associate that with privacy and distinguish that from complete anonymity. Now, of course, there might be reasons why people prefer anonymity. And the problem is the trade-off between anonymity and financial integrity. And there are ways around this. There are ways to tackle this trade-off. You might imagine that transactions are anonymous under a certain amount. You might also imagine that transactions are kept private and the data is not touched unless there is a subsequent suspicion. And by a court order or whatever trigger, that information is revealed. That's a concept of what we might call traceable anonymity, or something along those lines. And the idea is to separate two groups. It's to separate the people who want privacy and perhaps a certain amount of anonymity for good reason, and the criminals. And the idea is that if you have traceable anonymity, the criminals may not like it because they know that they could get caught down the line. Whereas perhaps you and I, who want to, buy alcohol and we don't want our employer to know, or for whatever reason, legitimate reason, we might like it. And so that separates the two groups. And by doing so, it's very important. The group that uses money for legitimate reasons is no longer subsidizing the criminal group by adding liquidity to that means of payment. And so this separation between the two groups is something that is desirable.
Well, I really appreciate that answer, because I think sometimes there's, a lot of kind kind of fear or assumptions built into how these types of things can work. And I really appreciate you talking through how we can kind of think through those things. And with that, Tommaso, I think we are out of time for today. But I thank you so much for joining us at Meridian and sharing your research and thought leadership on the subject.
Thank you very much. It's a pleasure to be here. And I have to say, I'm very, very interested in what the Stellar Foundation is doing and following closely, as are my colleagues. So congratulations on what you're doing.
Thank you so much. I really appreciate you saying that.